Hello, good afternoon out there. Hope everybody's well. Jeremiah Conjure here from Annuity Association, and we're back for another exciting unbiased annuity review. And today we're going to be discovering the features, benefits, rates, and more of the Asset Shield fixed indexed annuity offered by American Equity Life Insurance Company. So I'm excited to dive into this annuity. This is a what we would call a pure accumulation focused annuity. It's designed to help pre-retirees and retirees a safe alternative to growing their money without market risk. So this is going to be a pure accumulation focused annuity designed to help those saving for retirement to grow their money safely, reduce their overall risk, and participate in equity markets without taking the risk that's normally required to do so. Without further ado, I'm going to go ahead and dive into our disclaimer and get that legal stuff out of the way, and then we'll dive right into the product brochure. And then momentarily after the brochure review, we'll be diving into the back-tested performance to see how this annuity has performed hypothetically over the last 10 and 15-year periods. We'll also be discovering what the best 10-year performance was over the last 20 years, as well as the worst 10-year performance, so that we can get a good understanding of how this annuity can potentially perform moving forward if the markets perform similarly to how they have in the past. So bear with us. Let's go ahead and get started in the disclaimer, and then we'll get started with the brochure review. Okay, here we go. Hopefully everybody can see my screen. You can also enlarge it by clicking the bottom right-hand corner of your screen, and it should make everything a little larger for you. Okay, so we're reviewing the American Equity Asset Shield 10 fixed indexed annuity. This is a review, not a recommendation to buy or sell an annuity. American Equity has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so that kind of leads me into, I always like to discuss, the premise of these product reviews and why we do them as a firm. And really it starts with bringing more transparency to the indexed annuity marketplace and the general annuity marketplace for that matter. You see, this industry is very antiquated. It's just within the last couple of years that there's been some advancements in technology and software that now allow us to go in and compare apples to apples, side by side, all of these available indexed annuities on the marketplace to be able to provide more transparency on the features and benefits that are available. But in addition, a true way to backtest these indexed annuities to see how they've performed or how they would have performed hypothetically if we owned them then. And our goal and mission with Annuity Association is to help you, the consumer, you, the potential buyer of these products, to make an informed and educated decision. And if you're like anything like myself, I'm one that likes to do my own due diligence and research in any of the products in any industry that I'm looking at purchasing. I want to make sure that I at least have a high level understanding of how they work. And from there, I can then start to analyze the various products and compare them side by side to determine which one's going to be the best fit for me and ultimately meet my goals and objectives. And so that's what we're doing with these reviews. When we say unbiased, they're truly unbiased because our goal is to help you find the right one for you. If you identify with a fixed indexed annuity as a good alternative investment option for you to reduce your risk and still give you that upside potential for growth. Well, we don't care which product you go into as long as it's the right one for you. We're an independent organization that's built with all of the products on the marketplace in our tool belt. And our job is to help you decipher through those different products. There's over 450 plus annuities on the marketplace today. And so our job is to help you, pinpoint which handful of them are going to meet your needs and goals. And then from there, determine, well, which one offers more features and benefits than the other that may have interest to you. So that's what we're doing with these reviews. So at any time during this review, if you have a question or you're interested in getting a comparison report on this annuity or any other annuity on the marketplace today, maybe one that you own that you're thinking of rolling out of, or one that you're being pitched by another advisor, and you're trying to shop the market, well, you can visit our website at annuityassociation.com, press the green button, fill out the form there right on the main page to request that report, and we'll get that out to you in a timely fashion. And hopefully, our intention is if we can add enough value in helping you make an educated decision, then maybe you'll give us a shot at the opportunity to earn your business. So without further ado, let me go ahead and dive into the brochure, and we'll get started with that. So thanks for your patience. I'm going to share my screen again, and we'll get started. Okay, here we go. Okay, let me see if I can make this a little larger by saving it to my desktop. Just give me 1 second. I will get in there and do that real quick. Bam, bam, bam. Asset shield. Okay, let's see if this will. Did it make it? It won't. All right, that's it. I guess that's going to be the largest we can get it for now. So hopefully that's big enough. I think it is. Again, don't forget to enlarge your screen. And actually, you know what? Let me try one more thing. I can open it in another software. Give me 1 second. I appreciate your patience. I should have been prepared. I didn't realize how small the brochure was on that viewing page. Here we go. Let's try this. Microsoft Edge. Boom. There we go. Okay, now we can make it larger. Perfect. Okay. So hopefully everybody can see that. Let me exit out of that one. Let me go back to this one. All right, let's get started. So Asset Shield is a fixed indexed annuity, and they have a little interlude here. It says every retirement is different with different financial goals and needs. Still, many of today's retirees' objectives are the same: asset protection, growth opportunities, and flexibility. Fixed indexed annuities offer benefits that help millions reach their retirement goals through guaranteed principal protection, tax-deferred growth, and opportunities for asset accumulation. One of the things, when we get into new meetings with prospective clients, and maybe they're not really well versed on indexed annuities so much as others, when they learn all the features and benefits, they always say, well, this sounds too good to be true. If this is the case, why doesn't everybody do this? Well, the answer is more and more people are finding out about these great products. There's a lot of biases out there on the money management side that keep the word annuity as a negative term, a negative phrase. When you hear the A word, you're told to run. But those are oftentimes people that either just don't understand annuities, or they're giving that negative perception. They're casting that negative perception over the entire annuity world, when in reality there's 5 different types of annuities. Not all of them are created equal. Some are bad, some are good, some are great. Just like anything else, just like stocks. Some stocks are bad, some stocks are good, some stocks are great. So with anything out there, there's the good, bad, and the ugly. And our job is to help help show you the best ones that are going to help meet your needs. But to make a further point there, the end of last year, I don't have the data for Q4 yet, but I have Q3. Over $25 billion went into indexed annuities in just Q3 alone for the year across the entire marketplace. So it does go to show you that there's a lot of people that are shifting their assets towards these vehicles because of the great benefits that they offer. So let's understand what fixed indexed annuities are. A fixed indexed annuity is a contract backed by the financial strength and claims paying ability of the issuing company. This guarantees contract owners a retirement vehicle designed to protect assets while allowing for growth opportunities. It does that through a combination of powerful benefits: principal protection, guaranteed income, tax-deferred growth, liquidity, and may avoid probate in the event of a death. How a fixed indexed annuity works. The retirement product is purchased with an insurance provider that, in turn, guarantees principal protection, tax-deferred growth on assets, and a reliable income stream if chosen. Throughout the course of the contract, the fixed indexed annuity can earn additional interest credits based in part on index increases. As an insurance product, the fixed indexed annuity is not directly tied to any index, so there are none of the exposure risks associated with direct stock or share ownership. The annuity cannot lose value due to index volatility, and the interest credited will never be less than zero. So that's a key point there. It's called an indexed annuity, but keep in mind your dollars are not directly invested in that associated index. The index is just used as a crediting strategy. It's just a performance indicator to determine how much to credit the contract based on the performance of the underlying index. Okay? So you never have risks associated with the index. The least amount of growth you could ever incur in any given year or crediting period would be zero. You'd get a 0% if the index went down. Very, very key there. So let's talk about American Equity. Why American Equity? This is a great organization, y'all. This company has been around for a long, long time. They're known for their customer experience and their service and commitment to their consumers and investors. And in addition to that, on the other side of the fence, they're also they're known really for treating their employees really, really good. It's something when you start to hear that, oh, American Equity, it's the greatest company to work for. That's something that we hear on our end from the people in the business. So I think that should be mentioned because there's a lot of companies out there that don't have that reputation. For over 20 years, American Equity has been committed to quality annuity products backed by superior service. Today, as the number 3 all-time fixed indexed annuity provider, American Equity remains focused on the business principles that have served their contract owners from the beginning. Through their financial strength and ongoing stability, American Equity will help fund more than 500,000 contract owners' retirements across the country. Currently, at the time of them writing this brochure, which is an updated version of 2021, they have approximately $57.67 billion in assets, 21,000 active agents, 500,000 active contract owners. They're an American-owned and operated company. And in regards to their financial stability, they hold an A- rating, which is considered an excellent rating from AM Best, an A- rating from Standard & Poor's, and an A- rating from Fitch. So solid company backed by proven performance. So key terms: annuitization is the conversion of cash surrender value of the annuity into regular guaranteed income payments. Okay, this is what, when you talk about these types of annuities, every annuity out there, there's 5 different types. Every annuity has the ability to convert the principal and interest into a lifetime income stream by using a method called annuitization. That is the traditional, oldest way of converting assets to lifetime income. Now, keep in mind, this is still a feature offered in every annuity out there, but less than 3% of all annuity contracts issued today take that annuitization route. Most of these indexed annuities offer what's called a lifetime income rider, which is a different way, and in my opinion, a better way to get a lifetime income stream, because when you elect to have the lifetime income rider, you're not giving up control of the assets. When you annuitize, you're foregoing the control of the assets, the principal and interest in the account, in exchange for that lifetime income stream. That's why very rarely is that option elected. So keep that in mind. Cash surrender value is the amount paid to the contract owner by American Equity when the contract is surrendered. Contract value is the verbiage for the total of the values in the annuity contract. death benefit, the greater of the contract value, or minimum guaranteed surrender value. Available death benefit payment options are listed in the annuity contract. So one of the biggest misconceptions about annuities, and a lot of the people that don't know annuities or understand them that talk bad about them, in the advisor world, they always tell people that, oh, when you die, the annuity company keeps your money. Well, that's not true. That's entirely false. There's only one type of annuity structured one way that does that ever occur, and that is in a single premium immediate annuity structured for life only. When you buy that immediate income annuity for life only, you're basically saying, hey, you're going to get, the insurance company is going to give you a stated amount of money every single month for the rest of your life. But when you die, that income stream stops, and there's no, you no longer have control over the asset. That's the only type of annuity that does that. In an indexed annuity, you have a death benefit value. The death benefit value matches the total accumulation value at any given time. If you were to pass away, in the contract, you have designated beneficiaries. So whatever's in the accumulation value at that time, 100% of that will go to your beneficiaries, and most oftentimes avoid probate in that process. Free withdrawal, so opportunity each year after the first contract year, you have access to up to 10% of the contract value without any withdrawal charges incurred, okay? So you do have liquidity if you put $100,000 in day one. After the first year, you can withdraw up to 10% per year. That includes any interest that's been accrued at that period of time. So if the 100,000 grew to 110,000, and the year that you're electing to take the 10%, well, then that means you could take up to $11,000 out of the contract to meet your liquidity needs that you might have without any penalties or charges for that withdrawal. Interest crediting strategies. So the contract owners choose from several index or fixed value crediting strategies, each offering different opportunities for growth. Minimum guaranteed surrender value. At no time will the cash surrender value of the contract be less than 87.5% of premium received, less any withdrawals accumulated at the minimum guaranteed interest rate. And partial withdrawal. Available at any time for partial distribution over the free withdrawal amount. Surrender charges and minimum values will apply. So what that means, a partial withdrawal is if you take above and beyond that 10% that's already given in the contract as a free withdrawal provision. If you take out anything above the 10%, that's considered a partial withdrawal, and the surrender charges would apply to any of those monies above and beyond that 10% free withdrawal amount. Rate integrity rider. So this rider allows surrender charges to be waived upon termination of the annuity contract if certain criteria are met as described in the annuity contract. So we'll cover that momentarily, but just to kind of summarize that this particular annuity offered by American Equity has this built-in rider, and it means that if the renewal rates on how the contract earns money based on the index performance go below a certain threshold that's stated in the contract, then that gives you the right as the investor to exit early, because essentially American Equity is not holding up to their end of the bargain. Now, I really look at this as, wow, they're one of the few insurance companies or annuity companies that offer such a rider. And I think it says a lot about the credibility of American Equity as well as their company's integrity, because if they're willing to put a rider in place that is basically guaranteeing that if they don't hold their end up of the bargain up, then you can exit with no penalty. I think that's what that tells me as an investor, is that, man, they're putting their money where their mouth is. They're basically stating, hey, we've designed this product to include these rates of the contract, and we're confident that we're going to be able to meet those obligations. And in the event, God forbid, that for whatever reason we can't, we'll let you exit out early, no questions asked. So I think that that's important. I think that's incredible. All right, surrender, termination of the contract in exchange for cash surrender value. And then a surrender charge is a fee charged when applicable for full or partial distribution over the free withdrawal amount. So annuity benefits working for your retirement. A fixed indexed annuity offers a powerful combination of benefits that help protect against many of today's common retirement concerns. So the 5 common retirement concerns are outliving their income, market volatility, tax exposure, liquidity, and legacy planning. So for outliving income, the way that the indexed annuity benefits that and addresses that concern is that you're able to secure guaranteed income that can be turned into lifetime payments. In addition to that, market volatility is addressed because you have a contractual guarantee of principal protection, and all credited interest from downturns are never lost whenever those volatility spikes incur. So what that's saying is that once you've accrued interest in the contract from maybe 1 or 2 years of the index performing well, whenever that market index does go down, all of your interest at that time is locked in. So you don't have to worry about losing that. You'll never ever go down once your principal and interest is in there, locked in for that given crediting period. It can never go down due to the index performing negatively. Tax exposure is addressed because money grows tax deferred, allowing for faster growth over time until money is withdrawn. Liquidity is addressed because you have up to 10% free withdrawals annually, plus partial withdrawal options and lifetime income flexibility. And then last but not least, legacy planning is addressed because you can protect your money from, market downturns and volatility, and your loved ones can benefit because from the time-consuming and expensive probate process, that is completely avoided. Let me say that one more time. You protect your money and loved ones from the time-consuming and expensive probate process. So that's very key there. All right, so let's keep on moving down. Asset Shield is a fixed indexed annuity designed to help protect hard-earned dollars from index fluctuations while offering interest growth opportunities based on increases in an index. So premium allocations, the word premium is another word for investment. So the initial premium payment can be allocated in any combination to either the fixed interest account or any of the index strategies within the annuity. Payments received after the initial premium automatically go into the fixed interest strategy. Contract values may be reallocated on the contract anniversary between strategies subject to these minimums. So what they're stating there is that you can allocate across the different index options that are offered or the fixed account if you so choose. So you can break down and allocate percentages of money towards the different ways that this contract can earn. So very cool. You have the ability to diversify within the annuity itself. Surrender values and charges. The annuity surrender value will never be less than 87.5% of the premium received, less any withdrawals accumulated at the minimum guaranteed interest rate. If a partial withdrawal above the free withdrawal or a surrender is taken during the surrender charge period, a deduction will be taken out according to the surrender charge schedule. Asset Shield is key for accumulation and withdrawal factors with Asset Shield Performance Rate Rider and market value adjustments. So the Performance Rate Rider, more options for magnified growth potential in exchange for a fee. This rider provides the opportunity to increase the cap participation rate or replacement rate on elected index-linked crediting strategies. The rider fee is locked in for the surrender charge schedule and deducted on the last day of each term. So performance rate rider, another terminology in the industry, is also called an enhanced participation rider. It's a way for the insurance company to offer you as the investor a way to increase your growth opportunity, because when you elect to have this rider added for a fee, and this will be covering the fee momentarily and how much that is, but when you elect to have this rider added, what it's doing is it's buying you essentially more participation rate or an increase in the cap rate. And so, for example, if you did not have this rider, if you elected to go without the performance rate rider and you chose the index crediting strategy, it may only be 50% participation. So what that means, if you're not familiar with the word participation rate, however the index performs for that given period, let's say it's 10% growth for that year or 2-year period. Well, if you have a 50% participation rate just means how much does the investor get to participate in of that index growth. So if the index itself grew 10% and you have a 50% participation rate, well, then you would be credited 5% of the 10% to your contract, because that would be 50% of that 10%. I hope that makes sense. Now, if you elect to have the performance rate rider, well, that might increase the participation rate from 50% to 100%. And so instead of only getting 5% of that index performance credited, you would get 10%, all of it, credited to your contract. So I hope I've explained that clearly, that you can understand that. We'll be diving into those specific, participation rates and crediting strategies that are found in this annuity momentarily. So just bear with us, stay tuned. All right, market value adjustment is the terminology for the product contains a market value adjustment rider. If a market value adjustment is experienced, it may increase or decrease the amount of a withdrawal in excess of the free withdrawal amount of the surrender value. The market value adjustment does not apply to free withdrawals, any death benefit, the minimum guaranteed surrender value, or any distributions occurring after the surrender charge period has ended. In general, as the market value adjustment index increases, cash surrender values decrease. As the market value adjustment index decreases, cash surrender values increase. So all a market value adjustment is you have to first understand the mechanics of an indexed annuity and how these insurance companies can offer such great features and benefits. First and foremost, they have to know that you're going to keep your end of the commitment for the term or duration of the contract. Many times that's anywhere from 7 to 10 years in these indexed annuities. And as such, with that long period of time, what the insurance companies do is they go out and they buy fixed income securities, corporate bonds and mortgage-backed securities and things. And they're going to be longer duration products, typically at minimum, 10 years. And so with that being said, when they're buying these bonds for the longer periods of time, their idea behind that is, they're going to earn a certain yield on those longer term bonds. And that's how they're able to add the features and benefits, principal protection and such of these annuity contracts. But if you exit your contract early and you forego the annuity altogether, well, they still have, they're still holding these bonds. They're still holding these longer termed assets. And so in order for them to sell out of them to get their monies out, since you did not hold up your end of the bargain, well, if the index, the market value adjustment index values have increased, well, then that means their monies are worth less because they bought them at a lower rate. They bought those bonds at a lower rate, essentially. And so what it does is just the market value adjustment's a way for the insurance company to cover their behind in the event the investor or consumer exits the contract early, that they're not losing, the whole farm on that exit. So just want to make sure that we understand that and keep that in mind. Asset Shield. American Equity utilizes indices managed by other financial institutions and industry benchmark index options like the S&P 500 to provide a selection of crediting choices linked to a broad range of domestic, global, and tech and biotech focused indices. So we have the Bank of America Destinations Index, which is called a multi-asset controlled index. It's designed in collaboration with Bank of America. This exclusive to American Equity Volatility-Controlled Index aims to deliver stability and growth in changing market conditions. So what's cool about these indexes is that you can actually go to the direct websites for these indexes. They have a ticker, just like a stock does. And you can look those up and see how they've performed. And we'll actually dive in momentarily to see how they've performed over the last handful of years. It's one of the things that we do at Annuity Association is that we really dive into the specific indexes that are available in these indexed annuities. and dissect them, and we figure out what they're made of, how they work, and we back test them to see how they've performed over longer periods of time. And what that does is it helps us as advisors build confidence in those indexes to help you as a consumer choose the right one. So one of the key things here is noting that these index strategies are exclusive oftentimes to the insurance companies. In this case, that Bank of America Destinations Index is exclusive to American Equity. No other insurance company can offer that index in one of their annuities. And in addition to that, as an investor, as an individual investor, these indexes are not on the public marketplace, meaning we can't go and just invest in them directly. We can't just go buy shares of these indexes directly on the marketplace. That's not possible. So keep that in mind. I get that question a lot. Well, if these indexes are so great, why can't I just buy them myself and not have the annuity? Well, first, you buy an annuity because of the contract. The contract has a guarantee that you can't lose money. Even if you could invest in these directly, you still would have risk. The reason why you look at an annuity is because we understand we have to be more conservative with our money, or we're just not willing to take the risk. And that's what an annuity does. So moving on, the Credit Suisse Tech Edge Index is also a multi-asset index. The excess return index combines 4 U.S. tech and biotech focused ETFs and 2 fixed income components. It utilizes a cutting edge target volatility control mechanism powered by SALT Financial to identify changing market conditions by using a combination of intraday and end of day data. The S&P 500, won't read that one. It's the traditional S&P 500, which is the benchmark of the stock market. And then they have a derivative of that at S&P 500 Dividend Aristocrats Daily Risk Control 5% Excess Return Index and a cash interest-free component. The underlying Aristocrats Index includes equally weighted constituents that have followed a policy of consistently increasing dividends every year for at least 25 consecutive years. And then we have the SG Global Sentiment Index, a global excess return index that uses 6 cross-asset capital market indicators to assess market sentiment and determine whether the market is in a growth, intermediate, or shrinking phase. Once the market phase is determined, the index allocates assets across a predetermined global and diverse asset base, including ETFs and domestic European and Asian indices. So these are really nice indexes that are found in this particular annuity by American Equity. Again, this is the Asset Shield. Now, if you're interested in really diving into these indexes, or maybe you like indexed annuities and you really are interested in just finding the best one with the best index, because that's the hardest part, is once you identify with the indexed annuity and you like it and you understand that, hey, I'm getting contractually guarantees of principal protection and upside potential based on how the indexes perform. Well, then the question then becomes, well, which index in what annuity with the highest rates? That's the key. There's 3 elements: best index options, best product that offers those index options, and the best rates for that index option. That's the hardest part, is finding those, but that's what we do. So we have the tools to be able to decipher all of the hundreds of different indexes and annuities on the market. If you're interested in doing a comparison and speaking with me directly so that I can help guide you in the right direction, you can visit our website at annuityassociation.com. Right on the main page, click the green button, put in your email address, and complete the form, and we'll get that comparison report out to you in a timely fashion. There'll be a section on the form that asks if you'd like to be contacted. Just select yes, and we'll give you a call to get in touch and see how we can help. So glad to have that opportunity. Thanks. If you're looking in the market, we'd be honored to be able to help. So appreciate that opportunity. Okay, so the surrender charge schedule, moving on. This is a 10-year contract product. They do offer a few other versions. I think they offer a 5-year. Yeah, they offer a 5-year, a 7-year, and a 10-year. Now, the 10 years are traditionally going to be the most commonly length contract in the indexed annuity marketplace. And the reason for that is because of it being what we call a time deposit vehicle, since you're not, being exposed to any risk whatsoever from the markets, it acts just like any other time deposit vehicle, such as a bank CD or a traditional fixed annuity, something with a tenure that you have to hold the money in the account for an elected period of time. Well, with that comes the rule of thumb that the longer you're willing to leave the money in, the higher the rates will generally be. So that holds true to the indexed annuity marketplace as well. The 10-year product will offer higher participation and higher cap rates than the 5 or the 7-year would. So typically people elect to go with the 10-year, but the 5 and the 7 is available. On the 10-year, we'll just look at that one. It does have the contract surrenders for the other two, the 5 and the 7 as well, which you can see here. But I'll just go through the general 10, which it looks like the numbers stay the same all the way through for all three versions until, obviously the last years of the 10. There's still a couple percentage points there. So 9.2% for year 1, 9% year 2, 8% year 3, 7% year 4, 6% 5, 5% year 6, 4% year 7, 3% year 8, 2% year 9, and 1% year 10. So what that means, if you decided to exit early or you needed a partial withdrawal, which is above and beyond the free withdrawal provision of 10%, let's say you needed 12%, well, 2% of that money, since it's over that 10% threshold for the free withdrawal provision, would be charged this withdrawal charge. So if you withdrew that money in year 5, 2% of that withdrawal would be exposed to that 6% fee on those dollars. So let's just say you had $100,000 in the account, and 10% is obviously $10,000, but you needed $12,000. Well, 2% or $2,000 would be charged a 6% fee on the $2,000 in that partial withdrawal. The surviving joint owner or beneficiary receives the entire contract value in the event of the contract owner's death. So keep that in mind in the event you pass away during the surrender period, during that 10 years. The beneficiaries in the contract are going to get 100% of the contract value. They will not be charged these surrender fees that you see on the screen. All right, let's talk about the money access and options and features. So with the Asset Shield, there is always access to money in the annuity. American Equity provides withdrawal flexibility and a variety of liquidity options. So we've talked about this several times. You get 10% of the contract value as a free withdrawal provision each year after the first year. On the rate integrity rider, let's talk about that. This rider allows for a waiver of surrender charges upon termination of the annuity contract during the waiver election period. American Equity will waive surrender charges if they declare a cap or participation rate for any crediting strategy included in the rate integrity rider that is less than or equal to the surrender charge waiver rate. The surrender charge waiver rate for each crediting strategy is determined at the date of purchase. Enhanced benefit rider is a no-fee rider automatically included for owners under the age of 75 and includes both a qualified nursing care and terminal illness benefit. So that is in the event, God forbid, you have a need for nursing home or you have a terminal illness. What this rider will do is allow you to access up to 100% of the contract value with no penalties to pay for that care that you might be, having to pay for down the road. Death benefit proceeds are paid to the surviving joint owner. If there's no surviving joint owner, the death benefit is paid to the named beneficiaries with no surrender charges. It's generally paid in a lump sum, but there are other payment options also available. All right, let's skip down to the Asset Shield 10, since that's the one that's typically sold on this product. If you'd like to review the versions of, for the 5 or 7 year, you can contact me directly and we can set up a time to go over that. So we've covered all of these features here, so I'm not going to continue to add redundancy to this review. But what we're really looking at here is just the interest rates that are currently offered at the time of this review. On the Bank of America Destinations Index with an annual point-to-point, it's an 80% participation rate. On the 2-year point-to-point for that same index, it's a 115% point-to-point. I'm not going to go through these all just for, one by one because we'd be here all day, but this is the available interest rate options and how the indexes grow and how your money grows according to the index performance. So I just want to cover the more popular ones. The Bank of America, 80% on the 1 year. On the 2-year point-to-point's 115%. On the S&P Dividend Aristocrats, it's a 70% participation rate on the annual point-to-point and 110% on the 2-year point-to-point. So remember, participation rate means of the index performance for that given crediting period, how much do you get to participate in? So on the 2-year, you would actually get above and beyond the actual performance of the index. So you'd get a 10%, call it a bonus, if you will. But let's say the index went up 10% for that given 2-year point-to-point period, then you would get 110% of that 10% credited to your contract, which would equal 11% total. Now, when you're looking at point-to-point and 1-year point-to-point or 2-year point-to-point, all that means is it a 1-year crediting period or a 2-year crediting period? And what determines the values of the index is on the starting day of that crediting period. So in this case, when you get your policy issued, that is your anniversary date. They'll give you the starting value of that index that you're allocated to, and you'll get a number. It'll say maybe like 250.59. Okay. Well, when they get to the end of that crediting period, which would be 1 year, so 1 year point to point is just 1 year from the starting point and the ending point. At the ending point, they're going to look at the same index value, and if it's higher than the starting point value, well, then the index had growth for that given year. And then they'll factor in the participation rate, and that's what gets credited to your contract as interest. Okay? Same thing happens with 2-year point-to-point. It's just the starting date and the ending point are 2 years apart. Same formula, though. They look at the starting value and the ending value, and whatever growth has been incurred, then they're going to credit, multiply the participation rate, and that's what they'll credit your contract. Okay, so without further ado, let's go ahead and dive into our software here. It's going to really help us understand the growth. When we look at this indexed annuity, we're going to look and back test the performance to see how it would have performed over the last 10 and 15-year periods. In addition, we're going to be able to identify which index and which crediting period and crediting strategy would have performed the best during that time frame as well. So these are all going to be listed in chronological order according to the highest performance to the lowest performance, using the 10-year column to the right. So if you look to the right here, we've got 10 and 15 years. This is from December 31st of 2010 to December 31st of 2020. And then on the 15-year period, it's December 31st of 2005 to December 31st of 2020. So the Asset Shield 10 comes in number one. Obviously, as I said, the longer duration contracts will offer higher participation rates in the contract to allow you to have more economic growth opportunity. Now, the strategy that performs the best, when looking back over the back-tested performance periods, is the Bank of America Destinations Index with the point-to-point participation rate strategy. This is a 2-year point-to-point. Now, you'll notice that this says with enhancements. This is including that performance rider that's offered in the Asset Shield 10 annuity. And the fee on that rider is 1.5% annually. So what that's doing is it's buying a higher participation rate because we've elected to have that performance rider added to the contract. Now, if we dive in real quick and just look at the enhanced rate participation for that fee. Let's see if we can find it here real quick. Okay. 2-year, oh no, that's not it. It's the Bank of America. 2-year Bank of America destinations point to point, 1.5% fee, and it's a 200% participation rate. Well, if we scroll up here and we look at the same index and crediting period, the 2-year point to point and that Bank of America destinations without the fee, so there's no 1.5% fee, our participation rate is 115% versus 200%. So 85% difference in the par rate, and that is why the enhanced rider is valuable in the sense that it's going to give us a higher par rate to earn more money as the index performs. And so we'll compare the feed version, a 1.5%, to the non-fee and see how it's performed during the same 10 and 15 years. So let's get into that. This bold black number here under the 10-year column, 10.78%, that is the average annualized credited interest rate for that 10-year period, 10.78%, based on the current contract parameters and the way the market performed during that 10-year period of time. This is back-tested hypothetical performance. If we were invested in this contract and everything was the same, apples to apples, this is how the contract would have performed. Now, keep in mind, I must make the disclaimer that prior performance is not always an indicator of future performance. It all depends on how the markets perform moving forward. But this is still a way to make an informed decision and get an idea of how they would have performed in the past if we owned them during this time frame. So markets don't always repeat themselves, so keep that in mind. And none of us have a crystal ball to know what they're going to do in the future. But what we do know is that when we buy an annuity, we're buying a contractual guarantee of that principal protection. So if markets aren't, favorable in the future, we're still protecting ourselves from that downside risk. But if they do perform, we still have upside potential based on the parameters of the contract with this 200% participation rate on this index. Now, you'll see two colored numbers down below the 10.78%. You have 13.16 in green and 10% in red. The 13.16 in green is what the software is doing is it's going back and looking at the last 20-year period and figuring out for us what the best performing 10-year period would have been during that 20-year period looking backwards. So in this case, it's from September 3rd of 2009 to September 3rd of 2019. This contract would have performed at 13.16%. In the red, they're 10%. That's the worst 10-year period of the last 20 years when looking back, March 16th of 08 to March 16th of 2018. That's coming right out of the global financial crisis, and it still performed at 10%. Now, when you're looking at these indexed annuities, they're not designed to keep up or outperform the stock market. I have to be clear about that. Do they have the potential to give you great returns? Yes. But we're not buying them to be our equities. We're not buying them to outperform the stock market. We're buying them as a safer alternative to allow us to get higher upside potential than what traditional safe money instruments can provide in today's environment. Bank CDs, money markets, even bonds, none of those types of vehicles and asset classes can give us enough yield to at least keep up with inflation. An indexed annuity does. And I always, tell our clients, if we can get within 4 to 6% of an annualized credited interest rate over a 10-year period of time, I think we're doing really well. And we're definitely doing better than any of those other safe money instruments would have provided. So keep that in mind. We're not, investing in these to outperform the stock market. Over the last 15 years, 10.11% was the average annualized credited rate when applying the parameters of the current offering to those back-tested years. Okay, so you'll see right below that, we have the 1-year point-to-point in that same Asset Shield 10 with enhanced rider of 1.5%. The par rate on the 1 year is 145%, and that's why you see the performance drop down. Okay, Now let's find the asset 10 without the fee. So I can go in and filter and make sure there's no fee. And you'll see the asset 10 with no fee now. It shows the 2-year Bank of America Destinations point to point with 115% participation rate. And you'll notice that the performance, the average annualized credited interest rate for that same 10-year period is 6.39%. So it went from 10.78 to 6.39 because we're not paying the fee to have the higher participation. So when I look at that, even from a consumer perspective, I can see that, hey, if I'm willing to pay the fee of 1.5%, it gives a very unique value proposition in the sense that you're getting a significant amount more of growth opportunity for just that 1.5%. Now, if you're the type of investor that says, hey, Jeremiah, I like things simple, I don't want a fee whatsoever, that's perfectly fine. It doesn't matter one way or the other which one you choose to us. It's that you're comfortable, and that your expectations and things are met, and your goals and objectives are going to be met as well. So if you don't want the fee, that's fine. We can do it without the fee. It's totally up to you and what you're comfortable with. Okay, so we've looked at the non-account feed version. We also have looked at the enhanced rider version. Let's go and look at the 7-year version. You'll see comes in at the same 1-year point. It's a 1-year point to point using the same Bank of America Destinations Index. It does have that performance rider of 1.5%, and the participation rate on the 1 year is 140%. So here's an interesting observation. In the 7-year, the 1-year Bank of America with the enhanced rider for 1.5% fee, the par rate's only 5% less than the 10-year contract. So it's 140% par rate versus 145. And that's why the growth is just slightly lower than that 10-year version. So that's another example that in the 10-year longer contract, you're going to get a slightly higher par rate because of that. Oops. Okay, and then the 5-year version comes in very competitive for a 5-year annuity. I'm really impressed by this one. 1-year Bank of America Destinations Indexed, 1.5% fee on there, 125% par rate, and you're getting a 7.05% back-tested performance over the last 10 years. Very, very competitive in a 5-year product. All right, so we've dove into these back-tested performances to give us an idea of how they performed. If you'd like to really dive in more and help us guide you in the right direction regarding this annuity or any other indexed annuity that you're potentially looking at, we can compare apples to apples using our software. You can chat with me directly and request a free report by going to annuityassociation.com. Right on the main page, click the green button to request your report. On the opt-in form, it's going to ask if you'd like to speak with an advisor. Select yes, and I'll give you a call, and we can get together at a convenient time that works best for you to go over these indexed annuities and figure out, which one's going to help you meet your objectives and goals. All right, we'll wrap up this review with one more area that I'd like to take a look at, and that is what we call our index indicator. So not only do we monitor all the products and offerings on the marketplace today, but we also really study these indexes to see how they're performing real time. At the end of the day, the annuities and all that can say all of this stuff, but the only thing that really holds true are the numbers. Numbers don't lie, and we like to specialize and focus our attention to the actual specific indexes first, because the index is the engine of how the annuity contract grows. So you have to have the know and wherewithal of that index, and know and understand it inside and out, and understand the mechanics of how it works in order for us to make sound recommendations. And so since we're looking at a couple of these annuities, or these indexes that are in the American equity, I'm going to go ahead and pull those up so that we can analyze their performance. real quick. So bear with me. I'm going to pull these up. Okay, we'll look at the top three. Okay, so let's go ahead and dive in and see how they've performed. Now, what this report is going to do is show us the current year-to-date performance. So we're only 2 months into the year, so don't really judge these indexes and the success of them based on the year-to-date performance. But really what we want to look at is longer periods of time. We want to look at the 5-year and the 10-year periods. That's really where I feel the most value can be perceived, is by looking at the longer periods of time. So let's just look at those, the 5-year period. Well, we'll look at 2019 first and foremost. Or we'll look at we'll just go down the line. 2020, the S&P 500 was in the red at minus 1.71. Now, because of it being in the annuity, you would have just had a 0 credited for that given year if you were on an annual point-to-point. The Credit Suisse momentum was 6 basis points in 2020, and the Bank of America destinations was 1.84%. Now, if you had the 200% crediting participation rate, obviously this number would be double. So your contract would have had 3.6, let's call it 3.6% credited for that year. In 2019, the S&P 500 Dividend Aristocrats was 6.93%. The Credit Suisse momentum was 7.98, and the Bank of America destinations was 10.91. Now let's skip over to the last 5 years. 3.81% for the S&P 500, 2.56 for the Credit Suisse momentum, and 3.19 for the Bank of America destinations. That's an annualized credited rate over 5 years. That's an annualized. Every year, that's the average. And then over 10 years, same thing. Annualized credited interest rate, 3.87% for the S&P 500, 4.49% for the Credit Suisse momentum, and 5.26% for the Bank of America destinations. So you can see why the Bank of America destinations came out on top when we were looking at that hypothetical back testing, because just with the plain index, it's performed the highest of those three. So I'm going to go ahead and wrap up our review for the Asset Shield 10 by American Equity Life Insurance Company. Now, if you'd like to compare this annuity to any others on the market, or if you're just looking at, really helping yourself find the best indexed annuity that's going to meet your goals and objectives for market protection, principal protection, opportunity for upside growth, or maybe you're looking for lifetime income, you can visit our website at annuityassociation.com. Right on the main page, click the green button, fill out the form, and we'll get that out to you in a timely fashion. And if you'd like to speak to me directly, just select yes on the question that asks if you'd like an advisor to contact you, and I will do so in a timely fashion. So thanks so much for tuning in. Hope everybody has a great rest of your day. Thanks so much for your time. Take care of one another. Bye-bye.